So there's a lot of noise about AI, but time's too tight for more promises. So let's talk about results. At IBM, we work with our employees to integrate technology right into the systems they need. Now, a global workforce of 300,000 can use AI to field their HR questions, resolving 94% of common questions. Not noise, proof of how we can help companies get smarter by putting AI where it actually pays off, deep in the work that moves the business. Let's create smarter business. IBM.
The news doesn't stop on the weekends.
Context changes constantly.
And now Bloomberg is the place to stay on top of it all.
Hi, I'm David Gura. Join us every Saturday and Sunday for the new Bloomberg This Weekend.
I'm Christina Ruffini. We'll bring you the latest headlines, in-depth analysis, and big interviews. All the stories that hit home on your days off.
And I'm Lisa Mateo. Watch and listen to Bloomberg This Weekend for thoughtful, enlightening conversations about business, lifestyle, people, and culture.
On Saturday mornings, we put the past week's events into context, examining what happened in the markets and the world.
Then on Sundays, we speak with journalists, columnists, and key political figures to prepare you for the week ahead.
Join us as soon as you wake up and bring us with you wherever your weekend plans take you.
Watch us on Bloomberg Television, listen on Bloomberg Radio, stream the show live on the Bloomberg Business app, or listen to the podcast.
That's Bloomberg This Weekend, Saturdays and Sundays starting at 7 a.m. Eastern on February 28th.
Make us part of your weekend routine on Bloomberg Television, radio, and wherever you get your podcasts.
Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, we'll look ahead to jobs data in the U.S. and what they may mean for Fed policy. I'm Nathan Hager in Washington.
I'm Caroline Hepker in London, where we discuss what the Made in Europe plan means for countries and companies.
I'm Doug Krisner, looking ahead to the reading on sentiment among Chinese purchasing managers.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Nathan Hager. We begin today's program with some key economic data in the U.S. We get non-farm payrolls for the month of February at 8:30 a.m. Wall Street time on Friday. For more on how this latest jobs report could affect Fed policy and interest rates, let's bring in Bloomberg International Economics and Policy correspondent Michael McKee. Mike, thanks for being here. Of course, this comes after that surprisingly strong January jobs report. Is that going to be a one-off, or could it be the start of a trend?
Well, that's the question that this whole data release will turn on. And for once, we can say that this is an important number because we've had several Fed officials say, particularly Chris Waller, say that if we get the same kind of number this month, then he would think that he probably would vote to hold instead of dissenting in favor of a rate cut on March 18th. So it does have some implications. Of course, the other side of that is, does unemployment go up? The forecast at the moment is for it to tick up to 4.4% from 4.3. That might not move the needle for the Fed, but if it were anything more than that, then they might get nervous and cut rates. So there's going to be a lot of scrutiny of this number this time.
So it sounds like it could really go one way or the other at a time when a lot of market participants have been thinking maybe the Fed might stay on hold just until we get a new chair.
Well, that's probably the case. It would, I think, take a lot for the Fed itself to change its views. In general, the majority are in favor of being on hold for right now because they think they're tight enough that they can bring down inflation if they leave rates where they are without hurting the labor market. Now, the question is, what hurts the labor market these days? Because with the lack of people entering the labor force, in large part because of all the deportations, what you're seeing is maybe 50, 60,000 being a neutral rate, the level that keeps the unemployment rate unchanged. And so if you get something much higher like we got last month, then it looks really good for the labor market and you don't need to cut rates. If you get something significantly below that, then they'll get a little concerned. Going into it, we're looking at about 60,000 as an estimate, but that could change over the week.
Of course, as you know, a lot of the discussion that's been cropping up in the Fed is about how artificial intelligence might be affecting the labor market as well, not just the immigration story. Do you expect that to feed into the February numbers, or is that kind of a broader discussion?
It's a broader discussion at this point. Most economists, I think the vast majority, don't think AI is showing up in the data yet, other than the the money that's being spent on building AI centers.
Oh, yeah.
But the technology is too new and hasn't been adopted by enough companies in enough scale to really change the way companies are organized. And so it's not going to be in the labor market data, and it's not been adopted widely enough to change the inflation data yet. This is something that's on the horizon, and it's certainly got everybody talking about it, but it's not there yet.
Well, one phrase I keep hearing from you in your coverage of this labor market is low hire, low fire. Is that still where we are? And if we do get some job growth in this report, where do you think it's going to show up?
Well, the best bet for job growth is going to be in healthcare services, because that's where almost all the job growth has been for some months. The people who take care of all the baby boomers who are retiring, that sort of thing. We haven't seen much job growth anywhere else. There has been some in construction because of the AI build out. But I think what we're still seeing at this point is a lot of companies sitting on the sidelines, not sure what the business climate is going to be like. And now even more so, it wouldn't show up in these February numbers, but even more so because of the tariff decision by the Supreme Court. We don't know what tariffs are going to be. We don't know when they'll put them on again. And so you don't know what companies are going to do. So at this point, don't look for a huge amount of hiring. And you're right, it's low firing. Jobless claims remain extremely low. Don't give any indication that companies are making big layoffs.
So does that mean we're in kind of wait and see mode as far as a company thinking is going in terms of where wages go as well? Because we, have heard at least some talk from the administration that they think that wages are keeping up with or even outpacing inflation at this point.
Wages have been growing a little faster than inflation, which is what you want to see. You don't want to see wages shooting up, because then that could create an inflation issue. But that's not the historical pattern. We did see wages rise significantly coming out of the pandemic because companies were desperate to try to get workers to come work for them. But now, since they're not hiring, wages have been coming down, and they're just about at a kind of a neutral level where they're not an inflation problem, but they're still enough to get you ahead of inflation. So the wage issue isn't going to change much probably either.
Appreciate this, Mike, ahead of another Jobs Friday later on this week. That's Michael McKee, international economics and policy correspondent for Bloomberg Radio and Television. Let's take a look now at some stocks making news in the week ahead. I'm Nathan Hager, joined by Bloomberg equities reporter Carmen Reinecke on another pretty busy week for earnings, despite the fact almost everybody's reported already. But we hear from a big name in retail this week, Target on Tuesday. It seems like it's been tough for Target for several quarters now, Carmen.
Yeah, it's true. So a key figure for them is comparable sales growth. It's been negative in the last 3 quarters, and it's something that analysts are expecting will fall again. So that's something I'm definitely going to be watching. Shares have actually gotten a little bit of a resurgence so far this year. They're up about 17% after 4 consecutive years of falling. So that's going to be really important. Earnings, generally speaking, move stocks. I'm also watching this after Walmart's report earlier in the month. It forecast less earnings growth for the year than Wall Street anticipated, and had a pretty conservative view of the U.S. economy and sort of unpredictable times for consumers, which I think raised a little bit of a red flag. So Walmart usually does offer a kind of conservative guidance at the start of the year and then raises it in the following quarters. But this is still one that people are really watching as, a bellwether for the U.S. economy. And Target is right in line sort of after that.
Yeah, absolutely. You mentioned that the stock has been on the rise since the start of the year, despite all the troubles. Does that really kind of raise the bar for Target when it comes to meeting those earning expectations?
It certainly could. It's the next catalyst for sure that investors will be watching for, deciding if they want to continue to buy the stock or sell. I think the Target's gotten so beat up in the last few years that it's maybe not the biggest indicator that the bar is raised, and especially because we know they're in the turnaround. I think expectations aren't super high for them, so we'll see. I mean, certainly bulls want to see this rally continue.
And we also hear from another software name, CrowdStrike, on Tuesday as well. Every time I think about CrowdStrike, I think about the outage from a year or so ago. Is that something investors still think about?
That's such a good question. I think that CrowdStrike was able to really move past that quite quickly. It's not something that I've necessarily seen as the biggest problem for CrowdStrike in the last few months. I mean, certainly the bigger thing that I'm kind of looking at is that we've seen really broad-based weakness in software. And this was actually one of the stocks that got hit recently when Anthropic announced a new security feature in its Claude AI model. So it's a cyber security company, and other companies sort of in that space, Cloudflare, Zscaler, SailPoint, slumped. So CrowdStrike's regained some of those losses. It's down still, though, 19%, almost 20% on the year. So that's actually something that I'm looking for sort of most in these earnings is what are they going to say about AI going forward and how they're incorporating it, if they're, they are worried about disruption, or if they sort of have plans to maybe integrate it and, build their business going forward.
With that kind of decline and with, the way that software stocks have been hammered so far in this discussion around AI disruption, you have to wonder whether after these earnings, maybe some investors might see CrowdStrike as a buy opportunity. Is that something that you're thinking about?
Oh, totally. I mean, we've seen so many valuations kind of come in because of these big sell-offs. So if you are a value investor, if you're even just looking for, stocks at a discount, there are a lot of names in software that maybe make sense. So definitely going to be watching there and seeing if investors, hear good things in the report and say, okay, this is definitely the time to buy.
And then on Wednesday, Broadcom reports its results. With all this nervousness around the AI spending story, where is the bar for the AI infrastructure company Broadcom?
Especially after NVIDIA, I think it's going to be really interesting to see how investors react to this report. So it's another chip maker. It's also kind of gotten some shine as maybe moving in and kind of grabbing more market share in the chip making space. But that being said, it's also kind of moved sideways this year. We've seen, investors really rotating out of these sort of big tech companies, these, early sort of picks and shovels AI companies, and into, just maybe safer parts of the market. So Broadcom's down 10% so far this year. And I'm just really interested to see how investors react to this report. Analysts still expect really solid figures out of Broadcom. So they're estimating, adjusted earnings per share growth and revenue growth of more than 28% for this company. So we could see another kind of similar reaction where, the results are really good and investors just still aren't convinced and, buying shares here.
Yeah, I mean, it used to be, it's 20-something% earnings growth was huge. But after NVIDIA reporting something like 70+%, the bar is kind of in a different place for these companies, isn't it?
Totally. And it's also just under this umbrella of the wide-based anxiety around AI and kind of coming from two sides. I mean, we talked about software, people worried about disruption there, but then on the flip side, all of the CapEx spending that's, boosted NVIDIA and, Broadcom would also be a beneficiary of is worrying to investors. They're worried about cyclicality. They're worried that it's going to stop at some point. So that's really, overshadowed just stocks in the AI trade, but the broader market.
Yep, some big names to keep an eye on this week. Thank you, Carmen. Really appreciate this. That's Carmen Reinecke, equities reporter for Bloomberg News. And coming up on Bloomberg Daybreak Weekend, we'll look at the Made in Europe plan and what it'll mean in the EU and beyond. I'm Nathan Hager, and this is Bloomberg.
I'm Barry Ritholtz, inviting you to join me for the Masters in Business podcast. Every week, we bring you fascinating conversations with the people who shape markets, investing, and business. CEOs, fund managers, billionaires, Nobel laureates, traders, analysts, economists, everybody that affects what's going on in the market. Whether you own stocks, bonds, real estate, commodities, crypto, you really need to hear these conversations. Sometimes it's behaviorists like Dick Thaler or Bob Schiller. Sometimes it's fund managers like Peter Lynch, Bill Miller, Ray Dalio. Sometimes it's authors, Michael Lewis, author of The Big Short and Moneyball. Regardless of the conversation, these are the folks that move markets each week. That's the Masters in Business podcast with me, Barry Ritholtz. Listen on Apple, Spotify, or wherever you get your podcasts.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Up later in the program, we'll look ahead to manufacturing data in China. But first, Made in Europe. That's the tagline of a new scheme to rejuvenate Europe's defense, energy, and manufacturing sectors. The raft of policy ideas proposed by the EU Commission is drastic. They include forcing government procurement processes to look locally, tying foreign investors into joint ventures, and hiring European workers. The act is set to be adopted by the EU Parliament next week. Let's get more now from Bloomberg Daybreak Europe anchor Caroline Hepker in London.
For decades, Europe has advocated for and been built on free trade. But in the next few days, the European Union is hoping to introduce a strategy to reverse the continent's deindustrialization. The so-called Made in Europe plan will enforce strict rules to keep investment, factories and know-how inside the EU. But it's causing fights, not just internally between countries within the EU's borders, but externally from those who are warning against protectionism. Recently, Stephen Cowell and I spoke to the US ambassador to the EU, Andrew Puzder. He called the idea a serious mistake.
Well, the Made in Europe rules would be a direct contravention of the not only the terms, but the spirit of the Framework Trade Agreement that was agreed to in Scotland, because we've agreed not to have those kinds of preferences between our two countries. And I think adopting them would be a serious mistake. I would say particularly in the area of defense, because we have a very intermixed defense industrial base between the United States and Europe. Many of the weapons, the armaments that we're using not only in NATO but also shipping to Ukraine have production capacities in Europe as well as the United States, and the machines that make them, some are made in the Czech Republic and Finland, some are made in the U.S. There's a very intermixed supply chain, a defense industrial base, and a focus on having our defense products be interoperable. In other words, that if we're a NATO member and we're producing military hardware, we want it to be we can't have it working for different sized train rails or weights that don't work on European highways. We have to have these things interoperable. And this Buy Europe preference, particularly in these defense procurement initiatives, is a real threat to our defense industrial base, and that worries me a lot.
That was the US's ambassador to the European Union, Andrew Puzder, speaking to Stephen Cowell and I on Bloomberg Radio. Joining me now to discuss is our Brussels Bureau Chief, Suzanne Lynch, and our Chief Europe Correspondent, Oliver Crook. Suzanne, firstly, what is the plan from the European Commission when it comes to this legislation?
Look, I think this is the culmination of a long-running discussion here in Brussels about the EU's competitiveness problem. We've been hearing for a long time about problems within the single market, that businesses feel that there are too many regulations. And I think those reports, those twin reports from two former Italian leaders, Mario Draghi and Enrico Letta, really focus minds in Brussels. So I think this Made in Europe plan, this Industrial Accelerator Act, is going to be the fulcrum of this plan to boost European competitiveness. And I think it can be seen as a kind of follow-up document or a riposte, if you like, to these calls for better European competitiveness, a stronger European economy that Mario Draghi in particular articulated in his report.
This push seems to be coming in some part from France, but it also has seen a lot of delays. Why does it keep getting delayed?
I think it's a sign. You're absolutely right. Look, France has been vocal for years about, its belief that Europe needs to be, as they put it, more strategically autonomous, that it needs to stand on its own when it comes not just to defence, but also to the economy. And, I think some of the stereotypes, Caroline, in Europe are sometimes close to bone. I think France has taken a more, we would say, protectionist approach to how the single market works for years in the EU. It's been always a strong voice for that. So, yes, France has been pushing this, and the French Commissioner, Séjourné, is in the lead on this. However, I think what we've seen is pushback, or at least deep questioning, by a lot of other stakeholders in Brussels. So, firstly, within the European Commission itself, that's where this plan is going to be published from. This is the starting point for EU legislation. There have been several other commissioners or their DGs, their sections of the European Commission who've had questions about this, about how it's going to work in practice, about how is it still in tune with the European Union's free trade policies, for example. So you've got initial blowback within the Commission itself before they even publish their document. And then outside the European Commission, you've got EU member states also questioning this. So you've got this coming down on the usual path, those more free trade economies, maybe the Nordics, Ireland, Germany as well. I mean, we've already had Friedrich Merz saying, yes, we agree there should be a bit of a made in Europe policy, but let's make sure that this is just in certain sectors and we don't go too far down that route. And then there's kind of a third pillar, and that's the other partners of the EU. So be it the UK and the United States, they've also raised questions about, at a time when these third countries are trying to move closer to Europe and are working closer with Europe, for example, on defence, why is the EU potentially putting up barriers, as they see it, to collaboration? So I think that's why there has been a delay. The European Commission is trying to get it right. Even though they know what always happens in the EU is this is just the first step. They will put out this Industrial Accelerator Act, and then everyone will pile in and try and get concessions and try and make changes. But they're trying as much as possible to get this to as close of a consensus document as they can before it's published here in Brussels.
Indeed. I mean, embedding European preference into public procurement, of course, it has unleashed a lot of questions within Europe and without. Oliver, in terms of your assessment of what's driven Europe into this new phase, maybe, of industrial strategy, I suppose remind us of why we're here and just what's at stake.
Well, what's really funny is that actually the Draghi report came out before Trump was elected president of the United States, right? And so there was this idea that this might just sort of end up in a drawer somewhere. It might just be, make for yet another report and a doorstop, for somewhere in Brussels. And then there was the election and inauguration of President Donald Trump. And then all of these questions about European competitiveness, the lack of it, the fact that they're not these big companies. I mean, you can really go through many of the sort of superlatives used by Mario Draghi. One of my favorite was that basically I think it was no company that was founded in the last 50 years in Europe's market cap exceeds something like $200 billion. And of course, every single one that exceeds $1 trillion in the United States was founded within the last 50 years. And so that is sort of the issue that is trying to be addressed here. And it was really brought home, obviously, with the MAGA sort of foreign policy, the America First. And then this American foreign policy that was obviously not just obsessed with tariffs, which it obviously was, but also taking a much more sort of active role in economic statecraft and, buying equity stakes in companies across the United States to try to stave off against some of the major issues that the United States saw within their own supply chains and within their own sovereignty, namely critical raw materials and things like that. And the problem is that under this Trump administration that has a much more sort of solidified and consolidated ability to exert power in the United States, the Europeans have sort of come up against the issue and the sort of obstacle that they now face in this sort of new MAGA-led world, which is that politically they're still so sort of fragmented and they cannot move with the same speed and effectiveness as the United States. So really, this is about trying to get the European economy further on sort of more economic footing, and it's really been brought sort of to urgency and brought out of the abstract, I think, by the Trump administration.
Yeah, absolutely. Suzanne, do you think that there will be a target for the share of European products that are domestically produced, for example? Will it go that far? Do these rules have the potential also to make Europe more self-sufficient in certain really, really key areas, like, defence, for example?
Yeah, I think there will be. I think this is where the point of contention will be. Who is a trusted partner, and how far or how much or what percentage of any rules, it's made in Europe only, for example. Now, I think there's a couple of things at play here. For example, there is a division, if you like, between, the EU is made of 27 countries with very different economies. So there's always been a suspicion by the smaller countries, frankly, that big countries like France and Germany, they have the resources to plough money into their own economies. But if you're from Finland or Ireland or, a smaller country, Estonia, you don't necessarily want to build a factory in your country, do you? No, you don't. You want you have thrived through free trade. You like this foreign investment by other countries, and that's what made you successful as an economy. So I think there are very different visions of economic success. And you're back to this age-old problem with the EU. One of the reasons as Ali just explained perfectly there, why the European Union is like this is because the European Union is not a country. It's a collection of different countries. So it's always been held back by this obvious fact that even though the single market does work in lots of ways, free movement of people, of capital, of labour, etc., there are barriers. And I think it was Ursula von der Leyen who used the example of a truck in Belgium, and there are certain restrictions on how much tonnage it can carry, and then when it goes over the border to France, that changes. Now, as an aside, that sometimes happens in the US between different states. But look, that does illustrate these issues, and that is replicated all over the place. If you're an accountant, you want to work in one country, but it's too hard to move your profession to that country. It's got different rules. But at the end of the day, these measures to fix that would require a ceding of national sovereignty in a lot of key areas by countries, and I don't think they're prepared to do that. So I think what we may see in this proposal is that sometimes the European Commission aims high because they know that it will be watered down eventually when it goes through the other EU institutions, for example. But they know there's always this inbuilt brake, if you like, on developing the European Union single market. But look, I do think, even though I mentioned about these divides about certain countries, even the most free trade minded countries accept that over the last few years, particularly on defence, but also since COVID, that the European Union does need to look after itself more, that there needs to be a turning inwards of such that you can't just depend on China, for example, for resources, or on the United States for trade. So I think the page has turned on that. Yeah. Also, I think another important dynamic is, and you're asked about the specifics of this when it comes out of the Commission, is that the European Commission and the EU leadership has shifted a bit to the right on this. When the European Union talks about reassessing some EU regulations, and they're doing this through these so-called omnibus bills, you will always have figures around the EU table who say, hang on, we can't sacrifice Europe's strict rules and regulations. That is part of what the public want, but also certainty for businesses. I think there are fewer of those voices now. So I think that's one of the reasons the EU is kind of moving now, because it's kind of shifted more, for want of a better phrase, to the right on this issue since the last European elections.
Suzanne, thank you. My thanks to Suzanne Lynch, Bloomberg's Brussels bureau chief, and to Oliver Crook, our chief Europe correspondent. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe, beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Nathan.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, we look ahead to PMI data in the world's second largest economy. I'm Nathan Hager, and this is Bloomberg.
Carol Masser.
And I'm Tim Stenovec, inviting you to join us for the Bloomberg Business Week Daily Podcast.
Now, every day we are bringing you reporting from the magazine that helps global leaders stay ahead.
We've got insight on the people, the companies, and trends that are shaping today's complex economy.
That's right, Tim. We're all over global business, finance, tech news, all as it is happening in real time. And we've got complete coverage of the U.S. market close. Gotta say, basically, if it impacts financial markets, if it impacts companies, if it's impacting trends and narratives that are out there, we are on it.
We also have a lot of fun
We
doing
do.
it. Bloomberg Business Week also brings you the analysis behind the headlines through conversations with our expert guests.
And we are doing this all live each weekday. And then we bring you the best analysis in our daily podcast.
Search for Bloomberg Business Week on YouTube, Apple, Spotify, or anywhere else you listen.
Check it out on your way home from work to catch up on the conversations that you missed during the business day.
And on the weekend, check it out for a complete wrap-up of your business week.
That's the Bloomberg Business Week Daily Podcast. I'm Carol Masser.
And I'm Tim Stenevec. Subscribe today wherever you get your podcasts.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. This week we get official PMI data for China. For a preview, let's get to Doug Krisner, host of the Bloomberg Daybreak Asia podcast.
Thanks, Nathan. It's not a secret. China's economy has faced many challenges in recent years. The most glaring is weak domestic demand. This is largely a reflection of a prolonged downturn in the property market. And with that soft demand, there has been entrenched deflationary pressure. Beyond that, there is U.S. tariff policy and an ensuing trade war, which really forced China to expand markets outside the United States. So will we learn anything new this week with the release of the official PMI data? Let's bring in Bloomberg's Alan Wong. Alan is China EcoGov editor, and he joins us from our studios in Hong Kong. Thank you so much for being here. Help me understand what's going on right now. I know we're just coming off of the Lunar New Year holiday. Can you give me a sense of what's happening in the big picture in regard to the Chinese economy?
Doug, I think the underlying weaknesses that you described at the start still remain. And then coming out of the holiday season, we now have more data points, but they do not paint a very clear picture of whether the Chinese economy is improving in a meaningful way. I'll just give you a couple of examples. We're seeing hotel stays, spending, and travel trips being up on all measures, but that is not as bullish as many people might think, because the per capita spending actually was flat. And the total spending went up, partly because the national holiday this year was 9 days long, which is 1 day longer than the previous year. And as you can imagine, if you get people more holidays, they probably spend more time spending and consuming. So that is some sort of a statistical noise that distorts the picture. And in terms of the PMI, the Chinese New Year is also injecting some uncertainty into just exactly how we can read it. We know that back in January, China's manufacturing sector contracted based on the official PMI, and economists forecasted the same degree of contraction almost in February. And you can imagine that because of the long Chinese Lunar New Year holiday period, factories might just operate at a lower capacities and orders might slow. So if those 2 months are contract consecutively, that would be a pretty rare event. We've only seen that happen twice over the last 10 years, that with the manufacturing contraction seen at the first 2 months of the year.
So is the problem in manufacturing and in turn the export economy in China solely the result of what's been going on with those U.S. tariffs and U.S. trade policy, or are there other factors at play here?
There are certainly many factors at play, and the tariff policy actually worked in a way that was quite counterintuitive. We know China said that it achieved its 5% growth target last year. It actually surprised lots of people because at the start of the year, with Trump returning to the White House, people expected the tariff policy to really slow China's exports to the United States. But export turned out to be a major driver of growth for China last year. But that was partly because of the tariffs, because how tariffs accelerated buyers in the U.S. and globally to front-load their orders. So people bought more than they would have otherwise, and that actually ended up helping China's economy grow as much as it did. So the question now is whether that effect has been exhausted and whether we're now seeing some sort of a payback period.
So my understanding is that China, in the meantime, has been looking for other markets for its goods. I know that the EV story, as it relates to Europe, is a big concern, but hasn't the business community in China been doing a very effective job at finding newer export markets?
They have. In fact, growth in exports to markets such as Southeast Asia, Europe, and Africa had been overperforming since the start of last year. And they more than make up for the loss to the U.S. market. But note that some of those shipments are meant for the U.S. at the end because of some of the goods are being rerouted to avoid tariffs. So there's actually not a very clear picture of how much those increase in exports to non-U.S. markets actually ended up in the U.S. and was tied to U.S. demand.
So, Alan, I'm curious, when it comes to the story on weak domestic demand, what do we know about efforts on the part of the government to change the narrative?
I think the government's efforts has mostly been to put a floor on the consumption trend more than really drastically boosting how much people spend. Because one long-time weakness in the Chinese demand side of the equation is just how wage growth has been slow and people are not feeling economically secure enough to spend more of their savings. And that has continued, and the government has used policies such as subsidies for certain purchases to encourage people to buy. But economists see those as short-term effects because people might just buy a refrigerator earlier than they expected, not necessarily buying more appliances than they plan to. So this is one way that the economists blame is how those subsidies are just front-loading the purchases, to use that word again, and not necessarily improving a demand for products.
So the Communist Party will hold the annual parliamentary meeting in a couple of weeks, the NPC. What do you think we're going to learn from that event?
The NPC will set the next 5-year plan for China's social and economic development. A lot of people, we will be watching very closely as to just how seriously China is looking to boost consumption. As we know, more developed economies rely a lot more on consumption, especially in the services sector, to keep their economy growing. And China has been a laggard in that regard. And the policymakers have for years tried to improve people's consumption, but that hasn't had a meaningful effect so far. And from the policy we've seen in the last 2 years, we can gauge how the underlying weakness is still a main drag on people's mood to consume. The other thing to watch out for from the NPC and in the 5-year plan in particular is just how important China sees technology as a future growth pillar. And there's so many different ways to look at this. AI is a big sector that China wants to grow, but there's also worries that automation and AI adoption could actually replace some workers, which, as you can imagine, will not help with consumption, right? If people aren't earning more money or earning enough, then they wouldn't feel confident enough to go out and shop.
Is the government involved in supporting research and development? Are there funds available for companies to tap into if they're trying to develop new forms of technology, whether it's related to robotics or artificial intelligence?
The government has some sort of national strategy to accelerate the use of AI and to make sure that it spreads to industrial use in a responsible way, in their words. But it's mainly the private companies, the private sector that have been pouring money into R&D in AI, building data centers. Our Bloomberg Intelligence Research estimates that China's AI companies will have spent $90 billion between 25 and 27 on AI. So that number is mostly a private company spending on these services and hardware just to stay ahead in the AI race.
So, Alan, in the last week in the States, we heard from NVIDIA. And on the call with analysts, the company said that competitors in China are making progress. So where is China right now in the race to produce advanced computer chips?
China, by most estimates, are still a couple years behind the really cutting-edge chip-making technologies. But it is catching up in many ways. And as NVIDIA flagged, there's real worry that if left to freely compete, China could really catch up with the U.S., but it's a constantly moving target, so it's up to anyone's guess as to just when China will catch up and in what sectors in particular. There are areas where China is lagging behind more than others, but there are also areas that China is seen as closer with the cutting-edge applications, such as when it comes to large language models. China is constantly coming up with models that surprise the U.S. competitors and leaders. And the U.S. leaders in this field, like OpenAI and Anthropic, have complained that China has been using their models to train their models to accelerate their development efforts.
In the next few weeks, we know that President Trump is expected to visit Beijing. In the last week during his State of the Union address, he vowed to keep fighting for his tariffs. And that seems very much related to the China story, although it is a little unclear at the moment. Trump did not mention China in his speech. And I think it's fair to say there's still a little bit of intrigue into how these new tariffs from the administration may impact China and obviously trade flows as well. Have you seen any clues on this?
I think the overall picture is that the bilateral ties will continue to be stable. There have been some recent developments, tariffs, but those are more marginal than compared to the broader trajectory of stabilized ties. For example, after the Supreme Court struck down some of Trump's tariffs on China, among other countries, the trade representative, Jameson Greer, said the administration would use probe into China's compliance with an earlier trade deal as a way to keep tariff levels up. So after that, China responded with a statement saying that if they use these so-called excuses to put new tariffs on China, China will have no choice but to use necessary measures to respond to the U.S. But after that, very quickly, Greer also said in a Fox Business interview that the U.S. doesn't seek escalation. So based on this exchange alone, you can tell that both countries still want to make sure that their relations are on a stable footing until at least the summit between Xi and Trump.
So what about the trade relations that China has with both Japan and South Korea? Obviously, those countries are U.S. allies. How would you describe the current flow of trade?
Well, China and Japan, they've engaged, and China and Japan are still locked in a pretty bitter diplomatic dispute over what Japan's leader previously said about possibly defending Taiwan in the event of an invasion by China's military. So trade has been affected to some extent. It's mostly the tourism sector and a few small pockets of the trade relationships where things are obviously been affected. But in the broad scheme of, in the grand scheme of things, they're not that important to China's overall trade. But there are some areas that even small steps might hurt either countries more. For example, if China uses this to further withhold the shipments of rare earths to Japan, it might impact some of Japan's sectors more than others. China recently imposed new export control measures on 20 Japanese companies, and then to put another 20 Japanese companies on a so-called watch list. So that just shows that China isn't giving up on its pressure campaign on Tokyo and on the Japanese Prime Minister Takaichi to drop her previous comment on Taiwan.
Alan, we'll leave it there. Thank you so very much. Bloomberg's Alan Wong there. He is China EcoGov editor, joining from our studios in Hong Kong. I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Nathan?
Thanks, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Nathan Hager. Stay with us. Top stories and global business headlines are coming up right now.
This is Tom Keene, inviting you to join us for the Bloomberg Surveillance Podcast. It's about making you smarter every business day.
I'm Paul Sweeney. We bring you complete coverage of the U.S. market open. We cover stocks, bonds, commodities, even crypto. All the information you need to excel.
And I'm Alexis Christoforous. Bloomberg Surveillance also brings you the analysis behind the headlines. We do that through conversations with the smartest names in economics, finance, investment, and international relations.
We do all this live each and every weekday, then bring you the best analysis in our daily podcast. Search for Bloomberg Surveillance on Apple, Spotify, YouTube, or anywhere else you listen.
On the East Coast, listen at lunch. And on the West Coast, listen as soon as you wake up.
That's the Bloomberg Surveillance Podcast with Tom Keene, Paul Sweeney, and me, Alexis Christoforous. Subscribe today wherever you get your podcasts.
Bloomberg Surveillance, essential listening each and every business day.